Hey guys, Jason here, and today I wanted to stop in with another 5-minute lesson and talk about principal and interest loans versus interest-only loans and how they apply to our property portfolio and how to manage some of the risk. Lately, there's been some changes in finance, and finance is always changing, and I wanted to tune in today, quick 5-minute lesson on how we can manage that, what the impact of that might be, and some of the things that we need to plan in advance as property investors to make sure we manage our risk, manage our cash flow, and keep going and build that property portfolio we desire. So stay tuned. Here's what I've done today on the board. Lots of numbers there, but let me explain just quickly. What I've done is I've laid out an average or an approximate, an example portfolio from a property investor. Most property investors start out with their home, their principal place of residence, and they use some of the equity in their homes often to use as deposits and borrowing for their investment properties. That's the example we're going to use today. We're going to use $500,000 loans across all of these loans or these properties, and we're going to see the impact between interest-only loans, principal interest loans, and sometimes how we can manage and forward think our risk and manage some of those changes that inevitably always happen over a 10 to 20 year period. As a property investor, we need to understand how to manage those risks. So let's have a look at this. We've got our home, we live in that property obviously, and we have a loan on that property. Often it's standard procedure, standard activity for an investor to use interest-only loans when you can get them. So let's say we had interest-only loans across all of our properties, and that's about $1,500. $1,575 on a 5% interest rate. I've put it at 5% at this point across all of our portfolio. Now, we're already living here, so we're paying for that. That's no big deal. These properties here, using a income of mum and dad here, with some tax deductions, these properties, as we purchase them, are positive cash flow after tax. Awesome, fine. That's great. Tick in the box, we're going along just nicely. But what happens if we have to now start paying principal and interest? What's the change? What's the difference? How do we manage that? You can have a look here. If all of these loans got changed to principal and interest, that would go to just over $2,000 worth of payments every month. Now, the interest is only still $1,575. That's the interest. That's the tax deductible portion. But there is an extra payment now every month of $438. Now, the good news is that's going to paying your properties off. Thumbs up with that, because really at the end of the day, we want debt down and we want income up. But can you afford that? Can that put a bit of stress or pressure on your home, your income, your world? And the answer is yes. More importantly, if that happens without your planning, how do we make sure we're safe, or we have some buffer or something to counteract or make sure we can weather the storm when those things change? The difference here would send these properties here, the positive cash flow properties after tax, which are great, into negative cash flow properties for a property investor. Now, that wouldn't be much chop for most people because we might not be able to afford that. How can we manage that not happening? How can we manage that in the future? Here's 3 tips for you. If you're in this situation, you need to lock away, get sorted as soon as possible. Understand what interest rate and loans you have across your portfolio. Now, you need to know the dates, how long they are, because when you first get a loan, they might give you an interest-only loan portion, an interest-only loan for 3 years or 5 years, and then it automatically reverts to a principal and interest. You need to understand what those interest rates might be and how long those loans are. Now, you need to know that it's going to happen or change, or it may change in 12, 18 months' time, not get surprised 1 week out when they send you a letter going, hey, surprise, it's going from interest only to principal interest. Find the dates, check them out, know what's coming, and plan in advance. It might be time to fix some of those if it's appropriate for you. If some of the interest rates fluctuations are a challenge, you want to fix that in. Make sure you go and have a look at the loan dates and make sure you have a look at the interest rates around that are very competitive, and it might be worth fixing 1, 2, or many of those loans, or a portion of those loans. There's a tip straight up. Understand what buffer you need. Now, buffer, when any person sits down and does a decent strategy, you have to have a buffer in place for things like this. Now, if you look at the difference here over a year, so we're looking at over $5,000, let's say, for a whole year extra cash flow negative for this investment property, $5,000, $10,000, $15,000 if it happened for over a year. Now, in a buffer, we would be planning, absolutely 100% planning, if that was, we had 3 properties and the change between principal and interest was $5,000 each, I would at least have 12 months worth of buffer sitting around. Well, how much would the buffer be? It would be 5K, 5K, 5K. I would be putting 20K aside in an account. Usually in the offset account is the best place. That can be in cash, it can be in equity, and it certainly can be in this stuff, which is tax deductions. If and when your property's a positive cash flow after tax, you claim that tax weekly, fortnightly, and monthly. It goes into your offset account and builds up your buffer. So I would always say you want to have 12 months worth of buffer minimum aside for risk or any situation that is unplanned, that you can't predict. You need to make sure the dates and times of your loans, you understand when they're coming, and if it's appropriate, it might be worth fixing in some of those costs. So guys, hopefully that made some sense today. Lots of numbers on there, but really at the end of the day, guys, the point is you've got to keep an eye on your cash flow, keep an eye on your loans, and always stay ahead, not be chasing your tail. So if you want to hear more, track us down at one of our events or watch more of our videos. As always, leave us a comment about today's lesson, or give me a shout out or what you might want me to cover in the coming lessons in the next days and weeks. So thanks for watching, and take care. Bye now.